Good morning, ladies and gentlemen. Welcome to Czech National Bank meeting with analysts. Today we are going to present you our latest macroeconomic forecast. After the presentation, we will open the floor for your questions and further discussion. Let me introduce you our today's speakers, Mr. Jan Procházka, member of the board, Petr Sklenář, Executive Director of Monetary Department, and Jakub Matějů, Deputy Director of Monetary Department in charge of Forecasting Division. So we can start with the presentation.
Good morning to everyone once again. Thanks for coming. Thanks for listening to us. Thanks for the discussion, which will be fruitful and interesting as always, I expect. And we are very much looking to your questions after the presentation. The structure will be as usual. I will speak about the forecast, the risks to the forecast, and scenarios which we prepared to illustrate these risks. First of all, the headline table, which you may have already seen the numbers. We expect inflation to stay close to 2.5 this year, itching down to 2.2 next year. About 27, I will get there, but this is affected by changing assumptions about ETS2, which had previously driven our forecast to 2.5, but is being postponed according to the news received 2 days ago. This is not in the forecast. Really speaking about the GDP growth, we expect this year to stay close to 2.3, coming a little bit stronger next year, 2.4, and on the back of recovering foreign demand, coming to 2.8 in 27. This is consistent with broad stability of interest rates this year and next. More importantly, what are the forecast and assumptions underlying this forecast? We did not change our assumption about the EU ETS2 impact. We kept it as in the summer forecast, which meant 0.4 basis points and decimal points, to be precise, 0.4 primary and 0.2 secondary impacts, equivalent to 28 euros per ton. But this effect, as we now know, will be postponed to 28, and this is not in the forecast and would move the inflation for 27 downwards compared to the numbers I am showing now in this presentation. So this is one important change which happened in recent days or hours. Another key assumption of the forecast is that the fiscal policy changes which may come with the newly elected government and the majority which is being formed are not included in the forecast. Finally, one third point, which is news after the finalization of the forecast, is the flash estimates of GDP for the third quarter, which is, I would say, stronger, substantially stronger than what we thought. We were relatively cautious, pointing to 0.2 Q-on-Q dynamics in third quarter, and the flash estimate is much stronger at 0.7. But we would say this only brings forward the expected recovery which we had in the forecast for the coming quarters. So the overall picture does not change, but the growth comes somewhat stronger than we expected, according to the flash estimate. October CPI also came stronger than our forecast, so also a marginal itch in the headline inflation numbers upwards. Speaking about other important expert judgments, we increased the expert judgment, reflecting the strong, rapid, and continuing growth of property prices and its impact on core price pressures relative to the previous forecast. We also work with stronger demand pressures in the sector of services related to rapid and broad-based wage growth. We also increase expert judgment, which relates to wages and service prices. Overview on the foreign outlook. On the left, you see revisions to in key economies and GDP growth. You may notice that most of the table turns marginally red, mainly in key economies for our exports, such as Germany, Slovakia. On the other hand, the table on the right, the HICP, the price pressures in these economies is turning somewhat upwards, also red, but in inflation that means upwards direction for us. Then it's not surprising that we revise GDP in Germany and overall foreign demand slightly downwards on the nowcast and also on the whole forecast, and the PPI, the producer prices in foreign economy are marginally higher, marginally stronger. We also adjust our euro-dollar trajectory according to market pricing, and we work with new trajectories for the US rates moving somewhat lower compared to the previous forecast, and the ECB cuts, which were part of the previous forecast, were now completely priced out. So stability of ECB rates is the assumption. The forecast leads to stabilization of inflation around inflation target, slightly above inflation target next year, and the uptick which happens in 27 is almost exclusively driven by the assumption of ETS2, which I've touched upon earlier, that will be postponed. Speaking about the composition of inflation, we expect relatively contained contribution from administered prices, indirect taxes, relatively negligible easing of food price pressures despite the flash. The direction is in terms of not repeating the rapid growth of previous years. But the key question is core inflation. We see substantial and still increasing contribution from imputed rent, which reflects on rapid house price growth, and we expect this effect to peak in early 26 and dissipate only very gradually over the forecasting horizon, still exerting inflationary impact on prices and core inflation. Disentangling from the model perspective the drivers of inflation pressures between costs and margins. The cost factors have relatively are relatively lower compared to previous episodes now. We still expect fading of present wage pressures. We expect gradually recovering labor efficiency, but at the same time, it seems that foreign price pressures, both in core and energy, are moving a little bit upwards. So that would be the structure of costs, and we expect the margins to grow somewhat below the target in next 2 years, mitigating the effect of slightly elevated cost dynamics. We still think that the profit margins are more elevated than is consistent with equilibrium situation. The GDP growth is a little bit ironic that we hit the number better with our summer previous forecast than by this one, but this is the fact that it came stronger, and the red dot here So I would say it questions a little bit our downward revision of the GDP trajectory, but I have to cite the numbers from the current forecast, which are 2.3 for this year and 2.4 for the next, and for 27 only marginal revision downwards. Regarding the components of GDP, I mean the story of that the growth is driven by private consumption on the back of strong real wage growth and overall disposable income growth. This is well received and well understood, so I would focus on other factors, on investment and net exports, which the investment especially has been early this year driven by change in inventories, some restocking, even front-loading related to the trade war. Now we see a pickup in public investment, and we expect it to continue in to some degree. But next year, the major contributing factor will be renewed private investment on the back of recovering foreign demand mainly. This affects also the balance between real exports and imports, where we have seen higher growth or higher dynamics of imports on the back of strong domestic demand, and a little bit negative net contribution of net exports. But also the exports themselves have surprised us by their resilience and strong growth given the overall uncertain foreign environment. But with foreign economic recovery, this gap will close and the net export will be more balanced, I would say. With this forecast, the consistent exchange rate trajectory is broad stability, marginally on the weaker side, which is, if I would be to cite some of the factors, it would be the relatively slowly recovering productivity in domestic economy, which keeps FX slightly on the weaker side, but really this is we see this as broad stability around 24.5. That brings me to the other lack of monetary conditions, and that is the interest rates, which we see this as relatively unchanged compared to the previous forecast. The detail is minor marginal upward revision and the size of 1 to 2 decimal points. First, on the downside, the important factor is stronger observed effects and stronger also near-term forecast of the exchange rate. On the other hand, upward factors are foreign environment, both the prices and the pricing out of any other ECB cuts. So the trajectory of foreign rates also moves upwards. There was some news about the stronger government consumption, mainly related to public sector wages. And also we increase, as I said earlier, the expert judgments related to prices of services, the wage growth, and house prices. Let me now move to the scenarios and risks to the forecast. We see as a major risk factor that the growth recovery, which is expected by the forecast, to mention the numbers again, we expect Germany to grow 0.8 next year and 1.5 in 27. So the risk is that this is too optimistic and that the fiscal spending package in Germany will not lead to a robust growth recovery. And if this will happen, the the growth might be, the growth recovery might be postponed to later to 27 with lower inflation pressures, because we interpret this rather as a weak demand than that the supply side factors would push to higher inflation. We prefer the story of the weak demand in this respect, leading also to more open output gap, more negative output gap, staying negative for longer than in the baseline forecast, and the ECB even resorting to cutting rates in next year. This would translate to let's say more expansionary monetary conditions in Czech economy, lower rates, weaker FX, somewhat weaker inflation, mainly in 27, and substantially lower growth. And the other risk factor in potentially opposite direction is a risk that the presently observed wage growth, which surprised us on the upside, will continue. To say again some numbers, in the second quarter we saw 2.2 Q-on-Q dynamics in wages. We expect slowdown to 1% in the third quarter. It may or might not happen. The wage growth might come even weaker, but we are afraid that it will stay on the stronger side. If this will happen and the wage growth will continue to print numbers around 7, it would boost domestic demand further, so this leads to stronger GDP growth, but also to the need of tighter monetary policy and higher inflationary pressures, which are contained by this stricter policy only to some extent. To sum up the debate or our feeling about the forecast and the debates which we had. In the direction of higher inflation, we see the risk of wage and service price growth being stronger, as illustrated by the scenario. We still see a persistent deficit financing of government expenditures, which contributes to money supply growth as a risk factor to long-term price stability. We also saw stronger flash estimates of both GDP for third quarter and CPI for October, which are pro-inflationary news, despite only maybe marginal, but in the direction of lower inflation. The ETS system, which we expected to kick in 27, has been postponed to 28, and this was not anticipated in the forecast, so that this affects the inflation and rates forecast for 26, 27 mainly. Then we see a risk of slower growth recovery in Germany, as illustrated by the scenario. Fiscal policy of the new government is an uncertainty, but it can go both directions, can have some anti-inflationary and pro-inflationary effects. We see house price growth as a key uncertainty. We see house prices growing recently around 15%, double-digit growth rates. Expect them to slow down. Risk is that it will not, or it can slow down faster than we expect. Therefore, we keep it as an uncertainty. The trade war effects have been muted so far, but we never know what happens next in this realm. And the Russian aggression in Ukraine is another geopolitical uncertainty to the forecast. With this input, the board decided to keep policy rates unchanged at 3.5. All 7 members voted in favor of this decision. As a last chart, I would try to, or I would bring to you the feeling which is prevalent in the department, and I would say in the whole bank, that the Czech economy and the monetary policy is in a good place, as borrowing term from Jerome Powell, and which was echoed further, not only in terms of solid GDP recovery, which does not bring new inflationary pressures which would accelerate inflation. So we don't see this happening. We see current account surpluses and relatively contained government budget balanced also compared to the region. So I would end here.
So let me now maybe briefly summarize the key topics what we have discussed in the bank board meeting yesterday. It was mentioned it was quite easy meeting because all 7 members voted in favor of this decision. It means that we keep our interest rate unchanged. But I would like to give you some insight and some points that we have discussed more than others maybe. I would like to add maybe 4 of them. The first is the labor market condition. There was a big discussion. I think the main discussion was about the labor market remained very tight. It's of course unemployment is still increasing, and the bank board also discussed the cyclical and structural changes and some impacts on the wages and the price growth going forward then. So I think this was the main discussion. Second one was the industrial sector outlook. I think that we all agreed that the situation remains very uncertain. The leading indicators are mixed, of course. We have discussed mainly the automotive segment and sectors, which is the key driver of the Czech economy and the development, and also we discussed the Germany, the effect of the fiscal stimulus, of the timing of the fiscal stimulus, and also everything which will be important factor for the Czech export. Third item was the fiscal policy. We are in a post-election era, of course, so we know the program which is available, but the quantification is premature. So the key question is still how the tax cut and spending increases and fiscal discipline will be implemented. So this was also some part of our discussion. And maybe the most interesting part, and it will be also in the monetary policy report, I think it will be issued on Friday, am I right? There was a box about savings. There will be a box about savings. You will see it on Friday. So you know that we discuss a lot the pent-up savings. The saving rate elevated since COVID and remains still significantly higher, so that we discuss if this reflects some kind of new normal, if the household consumption will be driven mainly by the growth in income, and then there is also part of the financial assets and about the investment of the Czech household. Then there was some small discussion about economic growth outlook, about flash analysis of third quarter, which was one shot, and about also housing market dynamics, which also makes us really nervous. So this was some kind of insight for a bank board perspective for you as an analyst. Thank you.
So thank you, Mr. Procházka, for your remarks, and thank you, Jakub, for your presentation. So now it's time for your questions. Just don't forget to activate your microphone, and please briefly introduce yourself. Yeah, yes, please.
Martin Mottl, Citi. Given the fact that this is my first forecast after more than 15 years, which I haven't been involved, so I'm really happy that I can ask in this way. So this new forecast is bringing so many interesting shifts in the variables. On the one side, we have a lower inflation, lower domestic growth. On the other side, we have a higher prices in foreign environment, lower external demand, and on the first side, it seems like this interest rate trajectory, which moved upwards, just reflecting rather this negative demands effects rather than like this balance of the positive inflationary risks. So I was curious about the decomposition of the interest rate. So I now see that it's the beginning of the horizon is driven mainly by this expert judgment, which I'm just okay with that because of this inflationary risk. Based on the fact that the governor yesterday mentioned that all bank board members are still keeping the door open under both sides of reaction of the interest rates. What is your, at least the monetary department's probability of the possible future move of the policy rate? Because it seems that in terms of higher trajectory of the interest rate, it's like more likely on the upside with the possible hike than the next cut. And my second question, when I took a look now on this alternative scenario of the wage growth, I'm a little bit surprised of the your pass-through of the higher wages to the CPI inflation, because the standard pass-through, I think, is like 20% of the wage growth to the inflation. So please, if you just can mention what is the main driver of this higher wage growth, because it's a big difference if it's the main driver is accompanied, for example, by also higher productivity of or the higher wages are derived by, for example, inflation expectations, then of course the impacts would be higher, because the impact is like almost one-to-one of the wage growth to the interest rate difference in the PRIBOR. Thank you.
So maybe I will start. It's very strange to see you on a different side of the table, but thank you for it, and my colleagues will reply.
I will start. In general, I would say that we have not changed the main topic or the big picture of the forecast. I would say it's the same, only reflects the changes we can see from the economy, but the overall picture is the same, that the momentum of the economy has increased and remain robust. And I would say that it leads to the discussion about the wage growth. But the changes are quite small, and even the changes in the forecast for the trajectory of the interest rate, it's I would say minor or mild. We are talking about 10 basis points or something like that. So it's very, very small. There is no huge change as it was in the summer forecast. Now it's only minor, and it reflects the economic condition. So I would say there was no change in this term of the overall forecast and in the trajectory of the interest rates.
Yeah, I would say that the trajectory or the forecast as a whole is consistent to your questions on the direction. I would say that the forecast is consistent with broad stability of rates this year and next.
Next steps is, of course, the question on the bank board. But as you can see, according to our forecast, we mainly the consistent trajectory with the forecast is the stability of interest rates in coming quarters.
What is also for me.
Yeah, I can say that these are. We did not interfere with the standard model mechanisms we have there. You shouldn't really interpret the relationship between the wages and CPI as a pass-through of wage shock to CPI, because it's mitigated by stricter monetary policy. This should be made clear. But maybe you were asking that you might consider the monetary policy reaction to be too strong, given the wage growth. One factor to mention is that the technical way how this is done is that the monetary policy is each quarter is surprised by strong growth each quarter again and again. This leads also to gradual lift of rates above the trajectory which is in the baseline.
I would only add to this the wage growth, and I will look at this issue in terms of inflation. we don't consider the surprise of wage growth this year as a risk for inflation this year. The behavior of Czech household is quite conservative when we were talking about the higher savings rates. It means in terms or in theory of permanent income, it increased their spending behavior for the next year or next year's quarters. So it increased gradually, but still increased the inflation impact mainly for the next year. And there are definitely many changes probably in wage development. One is some structural changes, increase spending of households in services. It increased the wage growth in services. Maybe there is some still a reaction on the previous inflation episode when some wages lacked the inflation development, and none try to catch up it. So there are many factors. One of the important factors is the current discussion in public sector about the wage growth, which influences the decision or the bar about the negotiation of wages as well in other sectors than in the public sector.
For this discussion, I've prepared an additional slide as a motivating factor for why we did this scenario is that we observed not only growth in wages which surprised our forecast, but also very wage growth. That's all of, barring one, the healthcare and social work. All other sectors are above their long-term averages starting from 2009 to the previous, to the most recent quarter. So all of them are above. So this is very broad-based. This is a key risk to the forecast, and yeah, we needed to acknowledge it.
And next year, the government proposed to increase the wage growth in healthcare by 7%.
Yep.
We are back.
Okay, so Mr. Haverland, please.
Good morning, ladies and gentlemen. David Haverland from ING. I'll be quick, as Mr. Procházka suggested. So first question related to the forecast. If you could please shed more light on what led you on this downward GDP revision for both years. What was the thinking behind that? Because if we would look at the level, it would be pretty much substantial. And if we would see the decrease in energy prices suggested for the next year, would you consider kind of boosting the GDP growth again a bit upward? So that's the first question related to forecast. And the second question is more general. We have seen the Czech industry kind of muddling through for quite a long time. What do you think would have happened, or what would be the conditions so that we would see a proper lift-off of the Czech industry that would kind of bring the economy into a sweet spot? So what are the issues, whether you have been thinking about it? We know it's external demand weak, and we repeat it again and again, but whether you maybe see some other factors or opportunities. Thank you.
I will start with the GDP. There are two parts of the answer. One is short term and one is more like long term. The short term is that we saw very weak industrial dynamics in summer. We saw not very, let's say, confidence building dynamics of service sales and retail sales. So based on these key inputs in our nowcasting techniques or nowcasting processes, we thought that the third quarter would be much lower, as I said, 0.2. This would not only affect 25, but also have carryover effects into 26. But then another consideration came into effect, and that is German German growth and effects of German fiscal spending, which we now think we were a little bit too optimistic about in summer. Also, with the new German budget being voted for, or not having massive, let's say, investment impulses penciled in. Also, with the discussions with other central banks, with the Bundesbank, for example, they have very weak forecast for German economy. They don't see the expansionary effect of fiscal spending materializing at all, almost at all. So, being in these debates, we thought maybe the German recovery would not be so rosy, and the extension of this risk is the scenario which we have prepared.
In terms of manufacturing, I was started from the analytical point of view. What we can see that, for example, manufacturing in Germany is in decline for 7-8 years, and despite of this fact, the manufacturing production in Czech Republic is stable. It's not growing, there is mild growth up to 1%, but we can say it's quite stable. So it appears that it's more resilient to this negative impact than probably we would expect. So we are in slightly better condition. In the first half, there was increase in value added in manufacturing for both quarters. So it appears that there is some stabilization or stable development despite of the negative development abroad. So that's one point. Another point is there has been gradual increase in the utilization of capacity in manufacturing, and we are above long-term averages. So any additional push-up, maybe, for example, we expect it from Germany or in general from Eurozone, when there is increase in economic activity, will need to higher investment or fixed investment. And this could be another source of growth for the Czech manufacturing. Another one would say is adaptability. And once we're talking about the resilience, another one is adaptability, because, for example, when we look in the statistics of foreign trade, currently almost 1/4 of surpluses in cars in Czech Republic is done by export of EV cars. So, and the proportion is higher than is the proportion of the sales EV cars in Europe. So, again, it appears that this crucial manufacturing sector as car production is quite able to adapt to these new changes and is successful. And another important factor is, and it's difficult to how to analytically and statistically to cover it, is military production or the increase in defense spending, not only in Czech Republic, but as well in Europe. We have a capacity for this, and for a long time, some of the production was labeled as civic, and the same production of the same things are not considered as part of the military, or how to call it, or defense industry. So another additional positive factor for the manufacturing is this long-term trend. But still, we don't consider that the economic growth this year and the next year will be driven by next export or the increase in production in manufacturing. The economic growth this year and next year will be mainly driven by household services in these terms.
Because what you say, it seems that the Czech economy is in a good position, not only now, but even when we look ahead. So the question is, why do you have so weak growth or relatively weak growth for the next year? I agree with you exactly that the adaptability is there, that we maybe would have some progress in the defense industry. So that gives me a bit more hope you pencil in. So then it perhaps comes from weaker demand and the ETS2 effect, which of course maybe will not be there.
It's interesting how it is changing because in summer with similar feature we were considered over-optimistic. No, as we said, we are quite in a good place. We consider that the economy is in good shape, and the surprise in terms of growth, mainly from the domestic economy, is only in the upside side. Yeah, because when we see the level of the wage growth, it's high, and it will again increase the household spending next year, and it probably will bring the bar for the growth quite high for the next year. And the main risk for the inflation and for the economy is the development abroad, or the negative impulse from our trading partners. That was the reason why we prepared one of the scenarios, slower or weaker growth in Germany.
You asked what is the last piece in the puzzle. So we have discussed it also in the bank board. So, and there was a discussion about export, and what was mentioned, foreign trade and weak counterparts in Europe. So we discussed what is because there are some members of Ministry of Industry. So we discussed also export support and stuff like that. So. We discussed also about the competitiveness, what was mentioned, and there are so many surprises, and this is perfect. And what was also mentioned, defense and engineering, and some gap between these two segments. So it was also discussed in the bank board meeting.
Okay, Mr. Sobíšek, please.
Hello, Pavel Sobíšek, UniCredit Bank. I have a question to Mr. Procházka, which is directed somewhere else than before. But you mentioned that the banking board is made nervous by house prices. So my question is this nervousness related just to the factor of inflation in terms of imputed prices, or do you see some additional risk for financial stability? Thank you.
Okay, thank you for the question. So we discuss it. So I think the main part is that the property prices are growing faster and more persistently than projected in the summer forecast. So this was something which made us nervous. So because you know that the discussion starts, I don't know, 1 year ago maybe, then we added into our main forecast, main projection, but then we had some good news and good insight from our stability department that it will not remain, that it will stop, and it will continue in some decline, but we are still waiting for it. We do not see it on the market. We have some indicators which showed us that it will come, but it will still waiting for it, so we have to postpone it. So this was the discussion in the board.
Mr. Vejmilak.
Jan Vejmilak, Komerční banka. Hello to everybody. I know that we are in the Czech National Bank, however, for me it seems to be crucial fiscal policy assumption of the macro forecast, and this time I missed the regular slide in your presentation regarding fiscal policy assumptions. So could you tell us more regarding your assumptions, fiscal impulse which you expect? From tables you published this morning, it seems that you expect a deeper public finance deficit in 26 and 27. Jakub mentioned that fiscal policy changes of the new government are not included. And maybe a question to Jan Procházka. Fiscal policy is mentioned as uncertainty, and Jakub, as I heard correctly, said that on both sides that even, let's say, tighter fiscal policy can be expected from the new government. So could you tell us more? Thank you.
Maybe I will start with a few clarifications. We still expect the fiscal impulse this year to be roughly neutral, mildly positive next, mildly positive in 27, but these are really 0.1-2 percentage points, not 1 to 2 decimal points, nothing big. This is all based on the previous budget draft, so none of the potential plans of the new governments are in the baseline forecast. Maybe what I meant by the comment on both sides was that from an CPI accounting perspective, some of the communications might point to lower energy prices, the lower renewables fees, other things, the ETS postponement also, but not related to the government itself, but some adjustment in regulated prices of energies would point downwards. But it would be deficit financed, so the let's say the monetary impact on money creation and the fiscal impulse would be more positive, like just judging from the communication, but we don't have any clear numbers.
So maybe from my point of view, so I think maybe two notes. Fiscal measures will be incorporated into forecast only after legislative approval, as always. So this is the first one. So and the second one, I think that our approach, sorry, I'm not thinking, our approach will stay consistent. So it means higher deficit means higher money creation, money created, so higher inflation pressure, of course, and we will be explicit about it.
Okay, so Mrs. Tenconi.
Good morning, Rafaela Tenconi from Wood & Company. I have two short questions, if I may. One is if the Council has been discussing the impact of artificial intelligence on the labor market currently and with the next 2 years horizon, if you have any indication of whether this is a factor in the Czech labor market. And the second one is, since the incoming government is very open about the desire to control ČEZ, whether it would be legitimate to consider that at some point there could be communication between, or an expert opinion asked to the CNB about this project, since from our perspective that would have severe disruptions to the local financial market. Thank you.
So it's about a monetary policy meeting from yesterday. So I have to tell you that the first thing, we are big AI supporters, but we did not discuss it yesterday. So it was no discussion, not a piece, also not in a prediction. And according to ČEZ, it was also not a discussion about it. So, but as you mentioned, so we have to solve it and we have to discuss it and negotiate it. But yesterday there was no such a point.
I could only add that we, of course, follow this topic and permanently analyze as to the impact on the economy in general, not only in the labor market. Currently, we can see that we don't see any strong evidence that it would, in near terms, I mean, in next quarters, will influence the condition on Czech labor market. It could enhance in some way the productivity, but still the impact on the Czech economy in this term is quite mild or negligible.
If I may add, if anything, we think the AI improvements, the productivity gains will be something which would support potential growth in future years. We still expect TFP to be growing over medium to long term, to the future, and AI might be one of the factors keeping it.
Oh, yes, please.
Hello everyone, Adam Ruška, JNT. So I have a question about the exchange rate. You've said that in 2026 and 2027, you expect broad stability of the exchange rate mainly because of slowly recovering productivity. In the same time, you have GDP growth in 2026 nearing the potential growth and 2027 much higher than potential growth. Also much higher than in a foreign economy, and so also we have seen that in the Q3 of this year the GDP growth was higher than you've estimated. So maybe if you see now a potential risk of a stronger exchange rate, as I also noticed you have omitted exchange rate from your risk. So if you maybe see a risk of a stronger exchange rate stemming from the higher productivity as you have quite high GDP growth. Thanks.
Yeah, that can happen. What can I add? No, you answered yourself. Yeah, I mean we have I would say a relatively conservative assumption on the FX outlook. We think that current moves towards 24.3 might be affected by global sentiment, that the outflow of dollar assets into euro area, generally stronger euro, which translates also to stronger Czech. Therefore, we stick to 24.4 on the nowcast, or even for the fourth quarter. But we are now really speaking about not even decimal points, but bips. Productivity, normally we would expect faster recovery of productivity, but especially the third quarter, our expectation was weaker. Now, as you said, it comes again stronger. Might happen, but we don't see we have that we have like strong reasons to point our exchange rate forecast either direction.
So, Mr. Stupovský.
Hello, good morning. Michal Stupovský, strategist from Koncek. I have two questions today. The first one is a follow-up on the Czech residential real estate market. I'm just wondering, and I'm very curious, if you somehow account for the risks stemming from the strong boom of Czech real estate prices within your DSGE modeling framework, if it somehow directly impacts your model. That's the first question. And the second question, could you please at least briefly elaborate on your current estimate of the GDP growth of the Czech economy in terms of structural supply side potential, and how this estimate has developed since pandemic in 2020. Thank you very much.
Okay, starting with the real estate prices, mainly related to housing. This is one of the main reasons why we put that in these expert judgments. So this light gray part here is especially mostly or part of it, substantial part of it is related to housing. The fact is that we have expected growth rate of house prices this year around 10%, 11 back in summer. Now we see numbers closer to 14, 15%. We expected in summer then to slow down below 10% to single digit points in 26. Now we have to admit that we might be seeing double digit growth around 10%, 10.5 also next year. So this feeds through not only to imputed rent itself via the sub-item of new dwellings, but also to other pressures related to new furniture purchases and things like that. So it has broader effect, and it's not in the core model explicitly. So this is the reason why you see it here as an add-on to as an expert judgment, which does not affect only the prior trajectory. Of course, it affects the whole thing and the price pressures as a whole.
Yeah. We are permanently discussing about the potential of the Czech economy, and not about this. It's important assumption in the model, but after our analysis and discussion, we came to the point that we can keep our assumption that the long-term potential of the Czech economy is growth around 2.5. As it was before. There were a lot of, on one hand, and usually discuss the negative changes, but besides that, there are many positive changes, and one of them is that currently Czech Republic has the highest population in its history. It's almost 11 million inhabitants, and this, in fact, increases your production capacity of the economy, and helps to maintain the previous level of potential growth of this economy. So at the same time, still there is high investment growth, and this combination, increase in population, which reduces the risk from the aging and other factors, and at the same time, higher investment, and some gradual increase in productivity. Could maintain the long-term potential of the Czech economy is around 2.5%. Or, in other hand, we don't have sufficient evidence to reject this hypothesis or assumption.
Okay, thank you very much.
Mm-hmm. Okay, so we still have time for last more question. Okay, Mr. Dawn.
Thank you very much for the presentation. Mai Duan from Bank of America. I have to apologize to come back to the fiscal question again, given that there's a lot of uncertainty about it. But we do see the government, the new government coalition program. I would like to ask, you did say that higher deficit is seen in general by the CNB as inflationary, but if you could comment on the different measures and suggestion from this program of what can be more relevant from monetary policy perspective, what can make the central bank more anxious in terms of downside or upside risk to the outlook of inflation. For example, the cancellation of the renewable surcharge is lower on energy price, but at the same time it's budget neutral, but it's also more income for net disposable income for households. So if you could kind of give us some colors of what measures is more relevant for the central bank and how would you assess that? Thank you.
Okay, we prepare for the bank board for the meeting. I would say detailed analysis of the potential impact of the potential measures, but still it could influence the, I would say, the relationship between the politics and the central bank. So we will not deeply show the results, but definitely it will be included in the new forecast when the new government will be established and when there will be proposal, not only proposal, but the proposal of the government, what they intend to do. Still it's about the hypothesis, assumptions, what could impact, and we are prepared for it, but
I feel we are really prepared. Thank you for the preparation. So I think our team did nice homework. So I think they work hard, and we have it. We are ready, and then we will see, as Mrs. Šilerová said.
So thank you very much for coming, and many thanks to our speakers, and see you next time in February. Goodbye.